Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today would typically be the man himself, the governor of real estate, Mr. Michael Becker, but he just closed a large transaction, so he is taking a day off. In the podcast today, we have the professor himself, Mr. James Eng. James, how are you?
Good. Thanks for having me, Paul.
So what is going on in the Old Capital world? Again, we're the lender of choice for a lot of people, so I'm trying to figure out what are some of the things that people should understand of what Old Capital is doing for them today?
Yeah, we just finished up a lunch and learn with some of our guys over on the property management side. But coming up at the end of March is our bus tour. So this was, 40 or 50 people on a bus. We're probably going east this time. So we went west towards Irving. This time we're going to go east out to Garland, Richardson, that area, and sort of see some properties that we finance. So that's March 28th. And then we're bringing in Jeff Adler with Yardi on April 9th. And that's going to be a virtual deal. So if you're wherever you are, you can log in for that. But Jeff Adler is sort of like the chief economist for Yardi. So that'll be in about a month. And then we've got our big conference October 8th and 9th. So if you're going to make a trip out to Dallas, I would say make it around those times. So March 28th is the field trip. And then October 8th and 9th is the in-person conference. And
should people get tickets right now, James, for the conference?
Yeah, I mean, the conference price, usually we just increase it, $50 a month. So as soon as you know that you can make it in town, go ahead and get your tickets for that. That's usually a good plan.
That's great. And again, the bus tour is great. Remember, math is the same in New Jersey as it is in Los Angeles, as it is in Florida. When you get in the bus with us, we kind of drive you around and show you transactions that say Old Capital is closed on the lending side. We tell you a little bit about how these deals were structured. You can have a chance to meet some of the brokers that maybe put these deals together. So if you're thinking about, getting into multifamily, at least investing, don't do anything until you come see us, because we'll give you the banker's perspective and give you kind of just a high level of ideas on what you should be asking if you're thinking about investing someplace in the United States. And I will tell you that the guys that we've had are about to be on this podcast. They were at one of the properties last time, and they gave us a great insight on why the group bought it and how the deal was structured. And so it is a lot of fun to listen how these deals happen. It's really where the rubber meets the road. So in the podcast today, we have the gentleman from Rowan Multifamily Advisors, Rowan Multifamily Advisors. They're a Dallas-based investment sales brokerage group. I've known these guys, and James and I have known these guys for a long period of time. I know the founding member. I probably have known that founding member for the last, say, almost 30 years. A gentleman named Mike Burch. Mike Burch had a couple sons that have taken over the business. In the podcast today, we have Coleton Burch, Rowan Burch, and a gentleman named Matt Waskow. Matt, Coleton, Rowan, thanks for joining us. We certainly do appreciate that.
Thanks for having us, Paul.
Yep. Thanks, Paul.
So I'm just going to tell a funny story. I was out, and you guys have heard this story back about 10, 12 years ago. I was out at a property with your father, and it was an old property that you guys, I think, were listed for sale. This was kind of a vacant property. Maybe there was 15 or 20% occupancy in the property, and you guys were looking to try to sell the property. Your dad was out there in his golf shirt, nice pair of slacks, and we walked in the property, and you could see the water dripping from the top of the property down to the first floor. And it was kind of a property that had piers on it, post and piers. So it really didn't have a foundation, at least a concrete foundation. And the water kept on dripping, and it had been dripping on that property from the top to the bottom for probably about 3 or 4 months. And the wood around that first floor was getting very wet. And so we all walk in. Mike is trying to show us a little bit about this property. He walks over to the very, very wet area, and he goes from being on the top of the floor to being almost under the floor. The floor collapsed with him. He didn't get hurt, but went his very expensive pair of pants, and he went up to his waist in the wood thing. We all had a big chuckle and laugh at it. And you guys eventually sold that property, and somebody made a ton of money when they found out how distressed the asset was. And you guys get your hands dirty and you help people find value-added properties, stabilized properties. A lot of the properties here in the Dallas-Fort Worth area, you guys have sold either once, twice, or 3 times. And so today we're just going to talk a little bit about the state of the market, what you guys are seeing right now. And again, this is Rowan Multifamily Advisors, and they know a lot about what's going on in Dallas. I'm going to turn it over to James.
All right. Yeah. Why don't we just go around? I'll just call on you guys. Just give people a brief intro on yourself. And just for context, for the bus tour, we will not be going to that property. Just FYI. So, all right. Let's go to Rowan first. Rowan, give people a little bit of your background. Yeah. Go ahead.
Yeah. Rowan Burch. I'm born and raised in far north Dallas, Richardson area. Been here my whole life. Went off to college and came right back and got back directly into the brokerage business. I actually started with a large national firm straight out of school and was there from 2013 for about 3 or 4 years. And then saw what was going on over with Coleton and Mike and a couple other family members that worked together, and decided to go over and join them. So I've been in the brokerage business since 2013, kind of as this market ran up through the craziness of COVID and what happened after. I mean, it's been a great business, great market. Happy to be here. And right now it's a little tougher, but we are making stuff happen.
All right. Coleton?
Yeah, James, thank you. Coleton Burch here. I've been here in the business since 2011 is when I got in the multifamily brokerage business. And we started hustling some deals back when the prices were a lot different than they are today. And I've kind of specialized throughout my career, about 15 years in the business, in this kind of 50 to 250 unit workforce housing, multifamily asset class. And so we've sold a lot of them throughout the city, worked on a lot of them, BOV'd most of them, if not all of them. And so we have a pretty fair, we like to think at least, market knowledge, and would love to help whoever we can.
All right. Matt?
Yeah, Matt Waskow. I came straight to RMA back in 2013, so 2 years after Coleton had started the shop, and did the analyst, financial, and marketing stuff for about 4 years, and now been broker since. So grew up here. When I'm not working on multifamily, I've got a lot of kids. I've got 5 kids, so that keeps me busy, and my life is apartments and children, so it's great.
All right. So maybe we'll start here. So you guys were out in Vegas with us a couple of months ago, or just a month ago. What were you guys hearing? What were you guys seeing out in Las Vegas this year at the beginning of the year? I'll start with Rowan. Let's go.
Okay. Yeah, I can take that. So we've been out. We were out in Vegas. This is our 3rd year in a row to go to NMHC. We did take a couple of years off, but it was interesting. I think the turnout was a little bit larger than I anticipated, but we had a lot of good meetings. When we go to those things as brokers, it's set up to where we have, back-to-back meetings basically all day, 30-minute intervals, kind of like a speed dating event. So we see a lot of people. We talk to a lot of people, both from in the state of Texas and outside, looking to invest in the state. And I think my main takeaway was buy boxes have started to shrink. So what buyers are looking for has started to shrink, and they're trying to narrow down their targets. And really that's all based off equity. So what does your equity want? Where do you think your equity can be most aggressive? And it seems like that those buy boxes are shrinking down a little bit, which was interesting. That was kind of my number one takeaway. My second takeaway is it seems like there's a lot of equity out there looking for deals. Now, they're probably looking for the right deal. What the right deal is may be different from one group to another, but there is a lot of equity out there chasing deals, which is positive. And I'm hopeful that it leads to more transaction volume this year. But shrinking buy boxes and a lot of equity out there chasing deals.
Coleton, out in Vegas, any other feedback from guys or while you're out there?
Yeah, I think we met not only with buyers and sellers out there, we met with quite a few lenders out there as well, just that are servicing loans and are having non-performing loans. And one of the things that's kept things going in this market is these lenders that have kind of kicked the can down the road with their borrowers. And most of those lenders are saying, hey, they're kind of at the end of their rope. There's no more kicking the can down the road. And so that was an interesting fact. And I think that will force some guys to sell in the next year or so that may not be ready to sell. So we'll see how that plays out. That'll be an interesting factor. Also, like Rowan said, I think that there's a lot of equity that wants to do deals, but the equity is, still trying to figure out exactly what it wants to be in, what kind of deals, what kind of multifamily deals. So,
all right. I mean, leading into that, Matt, you have a deal, I think, that's on the market right now. Maybe give sort of a little bit, as much as you can, about that deal that's on the market right now. It sort of ties into what Coleton was saying.
Yeah, so the property, it's a 184 unit B class deal in southern Dallas. Asset itself is great. The timing of the acquisition, I think, is maybe the major issue with the performance of the overall investment for the current ownership group. About a year ago, we did a soft marketing of the property, kind of with a combined interest of the owner, to help them get some feedback on where the value is, with an understanding our underwriting was underneath the loan amount. Okay, so this was bought with a high leverage bridge loan at the peak of the market in 2022. Values have dropped, property performance had also declined. They used the feedback from the marketing, so the summary of offers that we had with numerous offers underneath the loan, to negotiate an extension with their bridge lender. That extension, really, I don't have all the terms of what they were able to get, but it got them a year. And in that time frame, even though they've improved the performance of the property, it's still not quite enough or really close at all to get them to a point where they can do a cash out refinance or a cash neutral refinance. It's kind of sad, some of these scenarios, but the property today is going to end up selling around 25 million, which is essentially loan plus closing costs. Hopefully a little bit more. We'll see how the marketing goes, but I think that's a really good example of peak market acquisition. Even if you've operated it fairly well, done some of your CapEx business plan, what can happen with a loan of that size?
And how has, I mean, maybe you guys have a couple listings on the market, and Rowan, maybe you take this one, just in terms of tour activity, buyer interest in deals, sort of what are you seeing out there right now? I guess we're here in March now, so in terms of
every deal is different. I think the deals that we're working right now are a little bit older in vintage. So these are 60s, 70s, 1980s construction properties. And the market for those type of deals in 60s and 70s is kind of its own little spectrum. It is a little bit smaller than it used to be. So people want a little bit newer class properties, and that's driven, again, by equity, like I mentioned earlier. But I would say tour activity is strong, but not for every single deal. Some of these deals, especially when you get to the older properties and the larger, older vintage properties, where you have a large equity check at an older vintage property, those are some of the tougher deals to sell right now. Now, on the other side of the equation, if you have a loan assumption deal, which takes the kind of the treasury market or the rate environment out of the equation, those deals are very highly sought after right now. So we've got a couple properties right now that we're working that are loan assumption deals, and the tour count has been pretty strong. Double digit tours. We've done one that we're marketing right now. We're doing kind of a quicker time frame on the call for offers, about a 3-week marketing process, but we'll end up with somewhere around 15 property tours there, which is pretty good for a 60s vintage asset. But I would say in general, it's very much deal dependent. There are still deals out there that are getting 40, 50 tours and higher, but it's not every deal. It has to really fit that buy box for a lot of the buyers out there in the market.
So you're thinking on a 60s deal, in order to really get tours and people out there, it needs that loan assumption for at least probably 4 or 5 years left on the term of the loan.
Yeah, it needs to have some sort of a compelling story. So it's that, or it's a really attractive basis, or there's a really big mark to market story. I mean, it just has to have a really compelling story to it, rather than a 60s deal where you can push rent a little bit, but they've kind of maximized everything else. Those deals, there's still buyers out there for those, but it has to have some sort of a juicy story to it.
Okay. Matt, anything to add on sort of tour count, and maybe go back over the last, let's say, 3 to 6 months, and deals that has sort of got under contract? What terms are you seeing on these LOIs? Maybe from LOI for call for offers to final sort of best and final terms.
So, yeah, good question, James. So I would say that the terms today resemble where they were maybe when I got into the business in 2013, very fair for a buyer. We're seeing 21 to 30 day inspection periods, 30-day close after that with two 15-day extensions. So a time frame of 90 days. That's for most new debt deals. A lot of assumptions will have some sort of a contingency on when they get loan approval, because those can take longer many times on the loan assumption front. So terms, I think, very balanced. We're not seeing many deals that have hard money day one, upfront, non-refundable earnest money, unless it's a low basis, maybe distressed sale. And that's a compelling part of the process, where you want to separate yourself as a buyer. That's kind of a separate niche in the, distressed sales versus your market sales. From call for offers, initial call for offers to a best and final, that process has also changed. We're seeing, maybe a little bit of movement upwards on pricing or strengthening of terms, especially from initial call for offer to best and final. A lot of folks, I think, for the sake of not wasting time, are kind of putting forth a strong number they believe in. And if that's of interest to the seller, they will, keep back a little bit of strength in terms, put up more earnest money, reduce timeframes down a little bit, but they're not holding back a large percentage of purchase price because, likely they're kind of just barely at a transactable price as it is. There's not a huge jump there.
Yeah, you're not seeing people jump up, $500,000, $1 million from call for offers to on like a $10 million deal, right? Like it's just, they're not saving 5 or 10%.
Yeah.
And then, I know you guys have some deals on the market now, but then what about sort of pipeline wise? Are you guys doing a lot of BOVs? Are sellers coming to you? Are lenders coming to you? Who are you doing BOVs for right now?
We are talking to some lenders, doing BOVs there. There's a lot of these deals that, like either they're on bridge loans or Freddie floaters, where there's going to have to be a capital infusion put in by the borrowers in the near future. And they've already done that once or twice. And they're kind of ready to go ahead and, hey, if they can sell at a decent number, they want to go ahead and sell rather than putting that extra, $500,000, $1 million back into the property again. We're doing a lot of BOVs for people that are in those situations. There's also just some owners that, they've allowed their occupancy to drop a little bit just with trying to manage their debt, and they're just going to go ahead and sell those, best case scenario, at those levels. But we see a lot of loans that are coming due. In fact, there's one right now that we're late stages in discussing, that a borrower has thought they could get an extension. Their bridge loan comes due in the next couple weeks, and they're just not able to get an extension, and they're just ready to get it sold pretty quick.
So in that case, when the maturity is coming up, when would you guys like someone to reach out to you? Is it 12 months, 6 months, 12 days before the maturity? What's the ideal time frame to get the highest price, right? Because obviously you guys want the highest price and the seller wants the highest price.
We suggest 12 months before your maturity, even though we know you're going to be fighting for that extension and see if you can get it or whatever else you can negotiate. Right. But we would suggest you come to us 6 to 12 months, 6 months at the latest. If you wait longer than that, it's just not good for anybody. But we understand it's a difficult situation out there for a lot of sellers.
Yeah, James, there is debt coming due on over 42,000 units in DFW this year. That's about 170 properties. These are 50 units and up. So that's a lot of loans. In reality, if you want to sell this year, you should have started making plans, last year, at least giving it thought. What can you do at the property level? Start getting BOVs, making those steps to be prepared to sell.
Yeah, I feel like it's coming in waves. Like a bunch of stuff got listed sort of after NMHC. Call for offers are like this week and next week. And then I'm feeling like there's one more wave before summer. So, Rowan, what about you? Anything else on those questions?
Yeah, I would say, and this is less about the debt and more about just your financial position at the property level. But we have some clients, unfortunately, who are running out of capital, right? They're not cash flowing. They're having to feed the deal every month. And so a lot of those groups, they wait till the very last minute, till they have accounts payable starting to come up before they decide to do anything. That's not the right way to handle it. I would suggest coming to a broker sooner when you still have some capital reserves left to kind of, help the deal, because you can turn a situation. poor situation into a bad situation quickly if you wait too long and just hope that something's going to get better on the property level. So I would say that definitely plays into it as well. It's maturity of loan. How are you set up to operate the property if something goes bad, if you have a unforeseen capital project, if you have, something that comes up that you need to spend capital on. And then the third would be the property performance. Like if you're coming along and you're 95% occupied, collecting rents good, like very low economic vacancy, I would recommend trying to take advantage of that, because in this market, it's tough operationally. So I think those three factors are kind of the main things that I'd consider when talking to a broker considering a sale.
So let's talk a little bit about the elephant in the room. I mean, that is the ability to raise capital, the ability to raise equity to actually buy these deals. So we do see the distressed deals here coming soon to a market near you. But, debt is easy, but equity is tough. Are you seeing, let's just kind of ask the 20 questions. Are you seeing a lot of folks going through mentoring groups, going through ecosystems to try to raise money? The people that are buying your deals, are they looking to do value-added transactions? Are they looking to buy stabilized properties? Tell me, let's just go through it. Are you seeing the mentoring groups, are they a big part of buying stuff right now? And do they have the ability to raise capital?
There still are some groups that are very active and have the ability to raise capital. Those groups are being more selective on what they buy, but there's not as many of those groups as there used to be. The whole entire, that kind of ecosystem of teaching, networking, raising deals has shrunk. I think some people, had checks and balances in place and they've lasted a little bit longer than other groups, but they're still out there, but not as many.
So how are these deals getting funded if there's not the ecosystem to put the money into it? I mean, maybe talk a little bit about your last couple deals that you guys sold. How was equity raised? Was it from 1031 exchange? Was it for folks that had their own committed capital in the deal? Was it for new people that had to go out there that had never invested in 2021, 2022? Can you kind of set up in your mind who was funding these deals? We understand who the general partners were. I'm just trying to understand who the equity people were behind these deals.
Yeah, I think it's a combination of maybe all three, Paul. We've had some exchange buyers just kind of rolling over. This was a family office, kind of rolled their money from one deal into another. We have had some capital raisers that are, have a strong track record. They've been able to perform, especially we think on the larger deals, there are fewer syndicators because it's harder to raise larger amount of money. But for those that can, they just seem like machines at it. And they've been very competitive, and they have a strong repeat investor clientele. If you have a strong track record, people will keep funding money, so we see a little bit of that, and just a lot of opportunistic new buyers to the market in general is what I'd say. For all the headwinds, there's also a lot of, cautious optimism from new investors entering this market. If you weren't playing here when things were tough in 2022 and you see the discounted pricing, that's an exciting opportunity. There's still some upside, and there's still a lot of good macros for DFW as a whole. So I think those people bringing in, maybe they're raising money, but it's from different sources than it used to be coming into Dallas. That can still be an exciting investment opportunity.
What are you seeing for these Class C properties in terms of occupancy? These older 1960s and 70s, whether it's a two-pipe chiller or it is individually HVAC in a little bit challenging demographics, are you seeing occupancies that once were 95, 96% down to 80, 81%? Are you starting to see a little bit of a fallback on some of these older assets?
I would say the trend is it was 95%, like you said, Paul, and the whole market was there. But recently, we're high 80s to low 90s is kind of market for these 60s, 70s, 80s vintage properties. So you get a property that's 90% occupied. Our biggest and first kind of thing we try to look into is what of that 90% are they actually collecting?
Yeah.
Right? That's an issue on some of these older vintage properties. Not everyone. A lot of the collections are great. But it's really, really crucial that your management is on top of late payers. Anybody that is behind on rent that you can file on needs to be filed on quickly, because we do see some big balances from tenants stacking up on certain properties. So occupancy is one thing, and then economic occupancy is another thing.
immigration issues at all? Are we starting to see like it was in 2008, 2009, where people were starting to lose their jobs? I don't know if we're coming into a recession, but are we starting to see folks that are concerned about immigration issues in some of these ownership groups?
I've heard a couple of rumblings from some property owners, but not at a level that I think would make a dramatic effect on the property. But it has been brought up.
It's yet to see how it plays out, but immigration and customs has gone to a few properties and, looking for people.
And there's been some like subsequent like self-deportation, people looking to maybe avoid going through ICE or something like that. So they just kind of pick up and leave. So a couple of skips, but what we've heard, at least I have, has just been small numbers, like few units on a several hundred unit property. Nothing to write home about, but definitely something to keep an eye on.
Yeah. Anything else? Who do you think, in terms of buying groups out there, what advice would you give for, especially if they're looking at maybe these distressed deals? Do they come to you? Should they be working with the lender? What do you think the best course of action for some of these guys to buy some of these distressed properties that maybe are like that deal that you brought up that has like 12 days to maturity?
Yeah. I would say reach out to brokers, reach out to us to help with the distressed opportunities. It's a really good time to get in. But what people have to understand is in these distressed opportunities, it's kind of a twofold. It's if it's a really good price per pound, it's probably not going to be a great cap rate, right? Or it's going to be a market cap rate and the price per pound's decent. You can't have something that's a crazy low price per pound and the going in cap rate is super high. You're just not, that's not where we're at in the market.
Can you give me an example of both of those?
Yeah. So there is a sub 100 unit 2017 property in North Dallas that we can deliver at a price around 175 a door, 2017 product.
Okay.
That replacement cost to replace that would cost 225 all day long. So you're buying almost brand new product, 7, 8-year-old product at 175 a door, give or take. But it's the cap rate is on a T3 basis is probably a 4 cap. You know what I'm saying? Because they've dropped rents and trying to survive, management issues, all kinds of things. So
is that at full occupancy though?
No, that deal's
okay.
85% occupied currently, but I mean, it's been as low as 70% occupied in the last 6 months.
You still need to do a bridge on it to get
correct.
Still need to do a bridge on it. Yeah.
Okay.
So that's like a good price per pound,
right?
But it's not a great cap rate, right?
Right.
And another thing is like, hey, a down the fairway deal that has been owned by the same group that we underwrote that's been owned by the same group for 10 years and they're just rolling out and they need to sell it. It's built in 1978. Like that deal's going to trade at just a real kind of 5.5 cap rate on like a T6 basis, T6 over T12 expenses. And that deal is going to be 135 a door for 20 or 1978 product, but a real 5.5 cap, maybe a little better than that. So,
but big units, right, Coleton?
I mean, normal sized units,
Matt,
but a good location. I would call it a B plus or better location.
So Matt, somebody listens to this podcast and they want to kind of talk with you and build a relationship with the Rowan team. What can they expect? I mean, you guys have the ability to look at a lot of transactions that people send over to you for you guys to do the broker's opinion of value. Well, someone coming into this that wants to buy, what type of relationship do you guys do? Do you guys send out newsletters? Do you send out, do they get onto your list? What kind of things should they expect from Rowan's Multifamily?
Yeah, so we love to develop relationships at a personal level. So we love to not just talk to someone on the phone. We'd like to go meet them for lunch, whether they own or do not own, just looking to break into the market and get a really good understanding of what they're looking to buy. As I've been in the business for a little over 10 years, I have a lot of clients that I've been doing business with for 10 years that we've bought, sold for, helped them grow throughout. And a large part of us being able to do numerous transactions with people is really understanding what they're looking for at that moment in time, where they're at in their journey as an investor, how much capital they have to work with, what type of product they like, what they don't like. And so we believe that's formed through time on the phone, time together in person over lunches and social and networking events. Once you make contact with us, we'll get an idea of what you're looking for. We will add you to our list, which will certainly get you all of our listed deals, as well as some of our select off-market deals, and then just keep it in constant contact. We do a quarterly newsletter that we just have kind of started back up and sent out over the last 10 days. So we try to incorporate a lot of data from different sources and put it into one kind of digestible format that someone can look at for a one-stop shop of general macro market conditions, as well as some micro examples of what's going on out there.
If somebody wants to kind of understand a little bit more about you and the Rowan team, what are some of the things that you are reading or looking at? Should they be looking at BizNow? Should they get an account with CoStar or Yardi? What advice do you have for somebody that's brand new, that's trying to establish a relationship? How do they get so smart to be like you guys that they see you guys as a huge asset for them? I mean, what are you reading these days that would help them?
We listen to you, Paul.
Paul, this is Coleton. I would say that we as a team, subscribe to all the services, the Yardis, the CoStars, all those things. We have a team of analysts as well, and all we do is multifamily. We don't do anything else other than multifamily. And really in this kind of workforce, multifamily is kind of what I would say more specialized even for me. And so we would love to help. However, if people want to know about neighborhoods or rents in certain submarkets or demographics in certain submarkets and the rental performance or occupancies, we'd love to help with that. Feel free to reach out. Like Rowan and Matt have said, we're long-term relationship guys. We're in this business for a long time. We'd love to help anybody get started and help them learn more about it. I think that if there was ever a time, if you've been, listening and learning about multifamily for years, like probably several people have, if there was a time to jump in, the time is now. We firmly believe that in the next 18 months, as the apartment starts slow down quite a bit, and we think rates will come down a little bit. I can't speak to how much they will come down or if at all, but we think they will come down some, and the rents will come up. And once that kind of cycle starts again with low rates and rents going up, we think it'll be back to the races in a frenzy like it was there for many years here in DFW.
Sounds good. James, any final words before we conclude?
Yeah. What's the best way for people to reach out to you guys? Maybe Rowan, wrap us up here with, best way for people to get on your list and just start seeing the deals you guys have on the market.
Yeah, I would say direct calls and emails. I mean, we're all three of us and the rest of the team is on the phone day in and day out, right? So calls, direct emails. Our website, rowanmultifamilyadvisors.com, is typically up to date with all of our current listings. But reach out. I mean, don't be shy to reach out if you're just looking to get into the marketplace. We're typically pretty easy to get a hold of. So reach out, phone or email, and we'll get you set up and looking at some properties.
I think that's great. So I certainly do appreciate Rowan and Matt and the big dog, Coleton, being part of it, since I've known the Burch family for a long period of time. And I think they're real straightforward folks that know this business and been in this business for a long period of time, that I would just give them a call to build a relationship with them. So guys, we certainly do appreciate being on the podcast. James, we appreciate it. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.